Hello and welcome to another video. This video is designed for forex beginners, for persons who are interested in learning forex trading. Um, it's very simple, right? And in creating this video, it will take you through some very simple steps in understanding what the forex market is all about and how you can earn a living trading forex. Now, before I actually go into details as to what this is, let me give you a brief rundown as to what forex trading is all about. Well, forex, as the name suggests, foreign exchange, is a global marketplace where currencies are bought and sold. It is the largest financial market in the world, with over $6 trillion traded daily. Forex trading, it involves the exchange of one currency for another, usually in the form of pairs, such as we know the US dollar and the British pound and the Japanese yen, right? So an example of such is the Great British pound trading against the US dollar, okay? Or the euros trading against the US dollars. They exchange euros for US for euros, or GBP, as in the Great British pound, for the US dollar, US dollar um, for the Great British pound. Good. So when a person trade forex, what they do is essentially bet on the future price movement of one currency relative to another. The goal is to buy a currency at a very low price or sell a currency at a very high price, right? So that's just a basic overview as to what the forex trading is all about. Now, how does it work? You see, the forex market, it operates 24 hours a day for 5 days of the week. And it's a decentralized marketplace, meaning there is no central exchange like the New York Stock Exchange, right, or the London Stock Exchange, or in our case, where I'm from, Jamaica, we have the Jamaica Stock Exchange, right? Instead, the forex trading happens directly between parties such as banks, brokers, institutions, or even individual traders, right? Now, when it comes on to the assets that are traded within the forex market, they are considered to be currency pairs. Every forex trade involves two currencies, right? The first currency that is highlighted is called the base currency, and the second one is called the quote currency. For example, we have GBP, right? Sorry, let me get that clearer. GBP, right? That's one of them. The Great British Pound have the US, for example, GBP USD. What this is saying that is the Great British Pound is a base currency, right? Base currency. Good. While the USD, which is a second currency identified right here, is the quote. Good. Or, for example, we have another one that is traded, the US dollar against the Japanese yen. So in this case, the US dollar is the base currency, while the Japanese yen is the quoted currency. All right. As was explained earlier, you want to buy a currency at its lowest price and you sell that currency at its highest price. So in the case of GBP USD or USD, the base currency, you would want to buy British pound when the price is very low. Sell the British pound when the price is very high. Buy the British pound, it is simply meaning you are also selling. Sell the British pound, it means you're buying the US dollar, and vice versa with the USD JPY. All right. Forex market. You can profit from forex trading by predicting whether the price of a currency pair will go up or it will go down. If you expect the base currency to strengthen, you can buy the pair. If you expect it to weaken, you can sell the pair. All right. That sounds very easy. Easy said than done, right? Now, if you're to say, take a look at the charts now, right? Let's take a look at the charts and see how this one works out, right? Looking at these candlesticks right here, these are representation of price movements, right? Red candles that we see, these are candlesticks, right? These represent the movement of price. Good. Let's take, for example, this one right here. This one. It is showing that price actually declined at this particular time. Good. Why do we say that? Because price opened right there. Let me use that. Here, price started its movement at 1.94512, and I'm looking at the British pound against the Australian dollar here, right? And price closed at, say, 1.924 1.92642, right? That's what happened. Price went down. Good. Right. Now, how would you know that price is going to go down? It's just a guess. However, based on all these candlesticks that you are seeing in the market, it gives evidence or give clues, so to speak, as to what price might do next, right? And this is where I am going to show you what to look for. All right. There is a thing called candlestick patterns. Candlestick pattern is a formation of candlesticks, right? One candlestick, or two candlesticks, or three candlesticks. They create a pattern that when you see these pattern in the market, it is giving a clue as to what price wants to do. All right. One such candlestick pattern that is evident in the market is what we call engulfing candlesticks. All right. See if I can, because I want to make use of the notes. All right. Engulfing candlesticks. Engulfing candlesticks. Here are bullish engulfing candlesticks, which means buy. There are bearish engulfing candlesticks. Engulfing candlesticks means to sell. All right. We're clear on that. Ooh. Around that, right? Bullish candlesticks give evidence of buys. Bearish engulfing candlesticks give evidence of sell. Now, what this means is that particular time, say for example, we are looking at a bearish candlestick, a bearish engulfing candlestick pattern, right? It is saying when you identify one on the chart, it is telling you that price want to sell or price want to go lower. All right. You see a bullish engulfing candlestick on the chart. It is telling us are giving us clues that price wants to go higher. All right. Now, let us see if we can identify some bullish and bearish engulfing candlesticks on the market. All right. Now, to as to what they look like, all right, the pattern looks like, and vice versa. What does a bullish one look like? So we have a bull candle, right? Bull candle that is engulfed by a bear candle. Sorry. Let me clarify that. With a bearish engulfing candlestick pattern, you have a bull candle, which means price was initially going up. However, sellers takes control of the market and pushes price below, which causes the candle, which is the red one, to completely engulf D of the previous candle, right? So here, this green area represents the body of the bull candle. And notice this big red candle, not the wicks that we're looking at, just the body, the big section, that's the body. If you notice that it has engulfed or take over or cover over the body of the previous candle, which is a green one. Vice versa with the bull, and that's for the bearish engulfing candlestick pattern. Whereas for the engulfing candlestick pattern, have sellers pushing the market down, but buyers takes control and push market back up, and in doing so, the body of the big green candle engulfs the body of the previous red candle. That forms a bullish engulfing candlestick pattern. Do that for clarity. All right. We have the bearish engulfing candlestick pattern. We have the bullish engulfing candlestick patterns. When we see it is giving us a clue as to what price wants to do. For the bearish engulfing candlestick pattern, it is giving evidence or clues that price wants to go lower. If we are seeing bullish engulfing candlestick patterns in the market, it is giving us clues that price wants to go higher. These are trading opportunities in the market. Once we see them, we can enter our trades trade them for one-to-one. When I say one-to-one, I'm talking about you're risking 1 to gain 1. And that is just for starters, right? There are other ways that you can utilize these candlestick patterns in trading, especially on a high time frame, for example, the 4-hour, or on the daily time frame. These can be utilized in various ways to get into trading opportunities. But for starters, these are perfect for one-to-one trading, one risk to reward trading. And I'm going to explain to you how this can be done as we go onto the charts. All right, there are different ways in which you can trade them in the sense for one-to-ones, but let's just keep it simple. All right, I'm going to go on the charts itself to identify some of these candlestick patterns. Good. Now, close to us here, we can identify a bearish engulfing candlestick pattern where we have price pushing up. Good. And then we have the sellers come into the market and push price down, where the candlestick here engulfs the previous one. Good. Now, what is this telling us? Price wants to go lower. If we are to use our position tool to show, to take a trade, a sell trade in this regard, we put our position tool right there, set our stop loss above the high of the engulfing candle, and we target a one-to-one, right? This it is saying we are risking 230 pips here to get 230 pips. And this is huge because we are on the daily time frame, right? But this is what it is. This is giving us evidence that price wanted to go lower. Did price go lower? In this case, yes, it did. All right. Now, let us see if we can identify a bullish engulfing candlestick pattern, which is very close to the bearish engulfing candlestick pattern in this case. Look at this one right here. Good. Let's see if I can box it out. Here we have, at this moment in time, price was pushing down. Good. All right. Let me use this one as an example. This current one right here instead of this one. So what's happening here? Price was pushing down because of this bearish engulfing candlestick pattern that was here. It gives an indication that price wants to go lower, which it did. However, in this case, as price is going down, we have the buyers who come back into the market and push price up. Good. Now that they have pushed price up, what is this telling us? Price wants to go higher. Now, is this a trading opportunity? Most definitely it is. So what we do in this regard, when the price closes, then we enter our buy trade right there. Now, when we enter our buy trade, we put our stop loss right to the low of the engulfing candlestick, and we target a one-to-one risk to reward, right? Yes, we are risking 161 pips to get 100 and we need to get it at 161 pips right there. Let's use it right there. Good. 161 pips. And as we continue looking at candlestick patterns, this is just using the engulfing candlesticks. We can look for engulfing candlestick patterns only and trade them in the markets. And this is just one currency pair, the GBP AUD, British pound against the Australian dollar. You can look at the British pound against the US dollar, the euro against the US dollar. You can look at the USD JP, the US dollar against the Japanese yen. And you identify these patterns right throughout, engulfing candlestick patterns, both bearish engulfing and bullish engulfing, right? You identify these right throughout and you trade them the same way and you would get the same responses. There are times when you might enter a trade using these patterns, and of course, you will be stopped out. And further on, in incoming videos, I will explain to you why this happens. All right? But for beginners, you can simply use these patterns to trade the market and make money out of it. In the comments, just identify these candlestick patterns. So I would call them candlestick pattern. Let me just do something here. Candlestick pattern. Candlestick pattern 1. Stick pattern 2. Candlestick pattern 3. Good. Candlestick pattern 4. Here. Stick pattern 5. 6. 7. 8. Yeah, that's it. Let's work with those. The British pound is US dollar, daily time frame. Identify 1, 2, 3, 4, 5, 6, 7, 8 patterns. What I want you to do in the comments is to tell me pattern represents, which number represents what pattern. All right, so this is the end of the video. I hope you enjoy watching it. I hope you have learned something from it, and in upcoming videos I'll be identify another candlestick pattern that you can use to trade the forex market. Thank you.